On the EA exam, qualified plan is a code word. It means the plan meets Internal Revenue Code requirements, so contributions can be deductible and growth is tax deferred. For businesses, the big fork in the road is simple. Is the promise about how much goes in or how much comes out at retirement? That's defined contribution versus defined benefit. Defined contribution plans give each participant an individual account. The employee, the employer, or both can contribute. The retirement benefit depends on what got contributed and how the investments performed. Think 401k style. You can predict the contribution formula, but you cannot promise a specific retirement payout. Exam tip: if the question mentions account balance fluctuates, that's defined contribution. Defined benefit plans are the classic pension. The employer promises a specific benefit, often a monthly amount for life. That means the employer takes on the investment risk and the longevity risk. These plans are expensive and rigid, so they're common in government and rarer in private business. On the exam, lifetime monthly payments is your neon sign for defined benefit. Here's the practical business angle. Defined benefit plans can allow very high contributions for certain high-income owners, basically to fund that promised future benefit. But they come with serious administration, minimum funding rules, and actuarial work. For defined benefit plans, ERISA expects funding to be certified by an actuary. So yes, they can shelter income, but they are not a casual DIY plan. ERISA is the federal rulebook that sits on top of qualified plans. It doesn't force an employer to offer a plan, but if you do, ERISA brings standards. It focuses on fiduciary conduct, protecting plan assets, reporting to the government, and disclosures to participants. It also ties into eligibility and vesting rules. On the EA exam, if you see fiduciary and annual reporting, think ERISA. That annual reporting is usually Form 5500, the Annual Return Report of Employee Benefit Plan. The due date is a favorite exam detail. It's due the last day of the 7th month after the plan year ends. For a calendar year plan, that's July 31st. Don't let answers trick you with 15th day language. Form 5500 is last day of the 7th month. For very small plans, you may see Form 5500 EZ instead. This is generally for one participant plans, owners or partners, and their spouses only. A common trigger tested is the asset threshold. When plan assets exceed $250,000, filing is typically required. Example: an S-Corp 401k covering only the owner and spouse with $275,000 of assets files. Form 5500 EZ, due July 31st for a calendar year plan. Ethan is the sole member of Harbor Bullion, LLC, and he deals in collectible coins and precious metals. A customer buys 15 gold coins for $13,200. The customer pays $6,200 in cash and the rest with a cashier's check for $7,000. What reporting obligation does Ethan have for this transaction? Think about it. The best answer is that Ethan must file Form 8300 within 15 days after the transaction. A trade or business that receives more than $10,000 in cash in one transaction or related transactions triggers Form 8300. The trap is thinking only the $6,200 cash counts. For this rule, certain monetary instruments like a cashier's check can be treated as cash, pushing it over $10,000. What is the deadline to file Form 5500 Annual Return or Report of Employee Benefit Plan? The options include several 15th day choices and one that says the last day of the 7th month after the plan year ends. Which one is right? Think about it. The correct answer is the last day of the 7th month after the end of the plan year. For a calendar year plan, that's July 31st. A tempting wrong answer is the 15th day of the 7th month, because lots of business returns use a 15th day deadline. Form 5500 is different. Last day, not the 15th.